and they're going to do it as delicate as they can in order to shrink their balance sheet over time. They're comfortable doing that because when the Fed first started raising rates, the 10-year Treasury was yielding 2.6%. Today, despite the fact that the Fed has been raising rates, the 10-year is down to 2.2%. So we've actually had, we have looser economic or financial conditions in the economy today than we had when the Fed first started raising rates, despite the intentions of the Fed to perhaps reduce liquidity in the economy.
So, Eric.
So let's move on. Oh.
A quick question. As we look at this on the yield curve, and the Fed's increasing, and we see maybe some volatility potentially at the long end because we're not quite sure what's going to happen with the Fed unrolling their balance sheet. Trying to make it a little bit more practical for us for a moment, what does that really do in terms of functional items in the economy like the 10-year Treasury? Is that going to be stuck in the middle? Is that something that we're not going to see a big change on? What's your feeling on that as an investment vehicle or as people who are just looking to refinance?
Well, the Fed has historically really only controlled the left-hand side of this chart, so the short end. They have become more involved during this last cycle in setting rates at the long end, but they can't truly set rates. They can purchase securities on the market, which does increase demand, but they cannot dictate that the 10-year Treasury should go to 2%. There's just too much demand, and we'll talk about that a little bit later. So essentially our view is that this curve will continue to flatten, mostly because inflation expectations remain muted, but also because of the relative value of U.S. Fixed income, which I'll show in a couple of slides. But typically in terms of refinancing, the 10-year Treasury has been the benchmark for refinancing and home mortgages. So if you think of the 10-year Treasury moving down, that's been beneficial for housing, that's been beneficial for home finance. But this has implications beyond the housing sector. It also impacts the corporate sector, and we've seen companies able to issue debt, and in many cases issue debt in order to free up capital to buy shares within their company, which has a positive impact on their earnings per share. So that'll also come into play as we talk about equities later on. And I hope that answered the question, Matt, but if not, please shoot me any follow-up that there might be. This next slide shows the two sectors that I mentioned on the returns graph, so showing how corporate spreads have really tightened. What this screenshot shows is the spread between a 5-year corporate bond and a 5-year Treasury. And you can see here that this has narrowed very significantly during the second quarter. On the next chart here, you can see this is a longer-term chart of the corporate spread on a 10-year high-yield bond. So high-yield are junk bonds. They are very low rated issuers of debt. But you can see that the bond investors are much more comfortable moving into junk bonds, and that the spread between a Treasury bond and a junk bond has really narrowed. Again, this is very bullish for the economy. This suggests that that we're going to continue to grow, that companies will continue to create value and really grow their revenue and their earnings over time. And then I mentioned briefly earlier in terms of our relative value versus meaning the U.S. relative value versus international bonds. And here we have Swiss, German, and Japanese sovereign debt. And you can see there's still a great deal of negative yielding bonds out there. These countries don't even turn positive in terms of bond yields until 5 years, or in the case of Switzerland, almost 10 years. And that's a very significant departure from where we sit currently in the U.S. Some money markets now are yielding 80 basis points up to 100 100 basis points here domestically. So, we sit very advantageously on a relative value versus international bonds. And given the credit quality of the U.S., we think that there's still demand out there for U.S. fixed income. And this chart shows really how strong that demand has been this year. We have not had a negative quarter in terms of capital flows into U.S. Treasuries. So we've seen a lot of purchasers from overseas buying U.S. equities buying U.S. bonds. And this is despite the fact that we've had a weak dollar this year. So since the Fed began increasing rates in the current cycle, the dollar is down 6.5% versus a global basket of securities. So we have been really attracting capital from around the globe despite maybe a weaker currency. So let's talk about risk for a minute, especially in terms of fixed income. This is a survey that Merrill Lynch does called their Global Fund Manager Survey, and it just asks portfolio managers, what's your number one risk that you think might sidetrack investments? And currently, the number one risk is a bond crash. It's maybe not a high conviction risk, as you've seen in the past, where China recession got up to 45% of managers, thought that was the number one risk to the markets. But it's a lower conviction issue. What could cause a bond crash? Well, I did mention that the Fed is entering a quantitative exit period. The Fed is also increasing interest rates, and perhaps not yet on investors' radar, but something that has influenced markets in the past. There's going to be a debt ceiling debate this coming fall. So we're looking really at three possible bond impacted events. But in our view, the impacts of those are temporary. The Fed is not looking to derail the bond market by any means. In fact, the Fed is very aware of systemic risk of making bond rates rise too fast. So we believe that they'll be very cautious. And ultimately, investors may have learned their lessons in the past from debt ceiling debates do ultimately get resolved. But until they do, that risk remains real. So now let's move on to a discussion of equities. Equity markets have been really in an unabated rally for a very long time, and I think that that has created both concern from certain investors, but I'm here to say that it's not all concern, that there's some good news. The good news is that we are in a coordinated global expansion. So the U.S., Europe, Japan, and emerging markets are all growing, and I think that that's very important for investors to understand that the global economy hasn't done this well in a very long time. Looking at emerging markets, the IMF forecast last year they were at 4.3% growth, GDP growth. This year they're forecasting 4.6, and next year 4.8. So you're getting a pretty nice growth rate and really an acceleration of higher growth rates in emerging markets. They're also bullish on advanced economies, a little less so, but last year advanced economies were 1.7% GDP growth. This year they're estimating 2%. So that's a pretty significant increase. And then 2018, they show a moderation of that down to 1.9%. So, I think that it's really beneficial for investors, and you see it in the earnings reports that have been coming out this quarter. You see that global growth really impacting U.S. companies, not only because of a weaker dollar, which means that every currency that companies earn overseas is worth a little bit more when they get back home. That's obviously a tailwind for U.S. companies right now, but we've seen growth across the board. In fact, in the second quarter, 77% of companies that have reported earnings thus far have beat on their revenues. That's a pretty good clip of revenue growth. In fact, the growth rate on the S&P just in the last 3 weeks, so since June 30th, has increased from 6.6% to 7.2% currently. So companies are growing, and they're doing so at a very good rate right now, and I think that that's a very important aspect of the current valuation debate to consider. So let's move on and talk about volatility. Volatility is another word for complacency, and investors are very complacent right now, and perhaps it has to do with the global economy all growing in a synchronized fashion. But we printed today the second lowest measure of market volatility ever. The lowest was 1993. You can see on this chart. Today nearly matched that. And the question or the concern that you have as an investor is that really there's only one thing that can follow complacency, and that is more volatility. So we are set for increased volatility. This has been a great period for equity investors, but it's a period that can't continue forever, and so there will be some market gyrations, both lower and hopefully higher. But thus far this year, it's been a steady climb higher, and I think investors are just very comfortable with that slow and steady return environment. And in fact, today we set the 28th new high, all-time high for the S&P 500. I think this chart is a really interesting way of looking at the S&P 500. This is not a valuation of the S&P, and it's not a price measure of the S&P. It measures how many hours of work an American worker would need to be able to buy the S&P 500. And as you can see, we're at an all-time high. But I think it's really important to consider that the companies in the S&P 500 today are worth a lot more than they were 50 years ago. So, companies are innovating. They're always looking for ways to increase productivity, to grow their revenue, to create new products. And this chart really reflects stocks as an investment. This is an inflation-adjusted measure of the value of the S&P 500. And it says that stocks today are more valuable than they were 50 years ago. Looking at valuation, on the other hand, does raise a few concerns. And this is a chart we've shared in the past, but it shows the cyclically adjusted price to earnings ratio of the S&P 500. And we are at the third highest level in terms of this data series, behind really the onset of the Great Depression and the peak of the tech bubble. And this is a valuation measure that scares many people. It does provide warning signs, but keep in mind that this measure also includes the most recent energy recession, where the price of oil dropped from triple digits down to a level in the 20s, which significantly impacted the energy sector. It also includes a time period where the Great Recession had very significant financial losses in terms of the financial sector. So it does need to be normalized a little bit. But even when you normalize earnings, they may not look quite as dramatic as this, but stocks are still fairly expensive. The forward PE on the S&P 500 is at a 10-year high at 17.8 times. And the price to sales of the S&P 500 is at the second highest level ever. And what that says as an investor is that you need to look at the market through, I think, several lenses. One is one of valuation. Look for opportunities where stocks might be trading at attractive valuations. But the other is earnings growth. And companies can grow into their valuations if the economic conditions justify doing so. And with today's low interest rate environment, the market is predicting that valuations do catch up. Here is really a chart on GDP growth, and U.S. growth is positioned really above average in the developed markets. So that is dollar bullish, and our firm-wide view is that we would not be short the dollar relative to other currencies. So we would be more of a neutral currency exposure. But as you can see here, the the U.S. is growing at a rate between 2.5% and 3% of GDP. Companies can create a lot of value in that type of return environment. So we think, that is a nice it's a nice GDP growth rate for what is the largest economy in the U.S. The days of us achieving 4% GDP growth here in the U.S. are long behind us, I'm afraid. So, and then finally, we'd like to talk about emerging markets and just asset class returns around the globe. Emerging markets have been a very strong outperformer this year, up over 20% year to date. Part of that is currency, which I've talked about briefly. So with the dollar being weaker, those investments held overseas have increased value. But part of it has been continued economic growth around the world and those higher growth rates of emerging markets. And in some cases, markets that are very levered to great demographics with younger populations that we think can grow faster than the global economy. And so lastly, I would say that emerging markets aren't as scary as perhaps they used to be. This last quarter, Samsung Electronics earned more in terms of net income than Apple did. And if you think of Apple as really the blue chip of all blue chip stocks here domestically, the most valuable company in the world, you have a South Korean handset maker that earned more than Apple did in the most recent quarter. And I think that really is a statement about how emerging markets can compete going forward, and it's something for U.S. investors or asset allocators to really be aware of.
Eric, as I look at this chart, and I apologize to those of you that have called in, but it has the S&P at the bottom, the MSCI World Index slightly above it, and then the Emerging Index considerably above that. I mean, really, the U.S. stock market then has produced drag on the overall asset allocation for most U.S. investors at this point.
Oh, thus far this year, that's been true. The U.S., specifically the S&P 500, has been the dominant index in most portfolios, or the dominant asset class exposure in most portfolios, for several years. That relationship is never true indefinitely, and that's why many investors advocate a diversified portfolio of different asset classes, such as emerging markets, such as bonds, perhaps an exposure to junk bonds, diversifying within equities as well, so small caps, value, growth. There are a lot of different types of investments available out there, and there's not a cookie cutter solution, I think, for most investors. But U.S. stocks have been the place to be for a long time period. And, I think thus far most U.S. investors are happy with the state of the U.S. economy and the state of U.S. markets as well. So perhaps you can find a little bit by diversifying into Japan or Europe or into emerging markets. But I think a lot of U.S. investors are comfortable with the risk here at home and the return profile that U.S. stocks have been producing.
So, Eric, before leaving emerging markets, we have a question that's come in on the Q&A. What countries are best for emerging markets, and how should we as investors approach these lofty valuations? And let's take those as kind of two parts, because I think the lofty valuations really applies to the U.S., right? So let's start off with what countries are best within the emerging markets.
Sure, and I will go ahead and advance our presentation to questions, and Matt, you'll talk about the right side of that after I'm finished. But thank you for those questions. The approach that we would advocate to emerging markets is really a shotgun approach, meaning we would not want to jump into any one particular country in a concentrated manner. We don't think that's appropriate for most U.S. investors because the risks are very significant. Political risk, currency risk, company transparency risk. There's really a lot of different things that can go wrong in the emerging markets. So make sure that your emerging market exposure is well diversified, first of all. But second of all, the countries we would advocate are countries that have higher growth potential, higher current growth trajectory. Countries that have that demographic pyramid that is heavier at the bottom, meaning that there's more younger consumers than older consumers, because younger consumers tend to produce a growing economy as they buy homes, as they buy diapers, as they spend more than they earn, and then as those consumers age, they begin to save more, which generally is correlated with a slower growing economy. So, particular countries that we like, Malaysia and Indonesia, India, countries that kind of the elephant in the room for emerging markets investors is China, which is around 25% of emerging market indices, and potentially growing with the introduction of mainland China shares into the MSCI index. So, China is, we're not negative on China. We have kind of more of a neutral view on China, but we are not overweight. So we would look to those faster growing countries first. And then Matt, what was the second question?
So you made this statement earlier that you think, at least in terms of a price to earnings ratio, that we have fairly lofty valuations within the U.S. markets. So as investors, how should we approach these valuations at this point in time?
Sure, we would not avoid equities at this point in time. I think if there's one point to be made during this presentation, it's that the economy is continuing to grow, and that is positive for investors. But we do think there are valuation opportunities in the market, and that investors should be cognizant of how much their exposure is to companies that may be trading at stretched valuations. But looking back to that chart on the Case-Shiller PE ratio, the CAPE ratio, and how it's at the third to highest level on that it's been measured, Robert Shiller, who developed that, recently forecasted equity market returns at around 4% for the next decade. Jack Bogle, the founder of Vanguard, also had a similar forecast of 4% nominal equity market returns. So, even I think a pessimistic view still forecasts, mid-single digits if you extrapolate out equity market returns over 10 years, and that includes what I would anticipate to be a fairly decent pullback at some point in the next decade. Equity markets are likely to have a 20 or 30% pullback at some point. So, I would advocate that investors should continue to invest for the long run, that can look for better valuations within the markets, and just be aware of what their exposures are and manage those appropriately.
Okay. So, Eric, I guess we're coming to the end of, I think, your formal remarks, and obviously we've opened it up for questions. I appreciate the questions we've received so far. Do you have any other thoughts you want to share with us regarding the markets? I noticed that your presentation kind of avoided mentioning the FANG stocks, or maybe that was intentional, but the FANGs have had an incredible quarter in the second quarter. Is there anything that you can talk about regarding how those have impacted the overall market and the significance that concentration has?
I can address that, and I also received a question directly via email that I will respond as well.
No, Eric, I'm sorry, that's not allowed. We said only chat or Q&A.
Sorry, it pinged me while I was here.
Okay.
So I'll start with the FANG stocks. In terms of valuation, that's where you start, and that's where you look at the equity markets. They have been very strong momentum stocks. The Wall Street Journal did an article last week where they reported FANGs have accounted, or four stocks alone, just four stocks have accounted for a third of the S&P 500's return this year. Those 4 stocks are Amazon, Apple, Alphabet, and Facebook. And I think that each of those would be categorized as a growth stock. Apple is the only one that pays a dividend, and this has been a technology-dominated equity market thus far this year. Tech is well over 20% of the S&P 500 currently. But there are risks there. I think it's for an asset allocator, you do want to have growth exposure within your portfolio, especially in a highly innovative economy that we have. But I think in terms of a full cycle, we have a value bias, and we would be looking for value at this point in time. Perhaps rotating out of some of those growthier positions and looking for companies that getting back to the winner's curse that I mentioned at the beginning of the presentation. Buying some of those momentum positions today, you risk winning the auction, but overpaying in doing so. And so we would be looking for companies where you can buy them, knowing that you're getting in at a below average valuation.
So Eric,
and then the question.
Hold on. I think referring back to that Wall Street Journal article, I think it said something to the effect that, and correct me if I'm wrong, their total value created in the U.S. stock market so far this year was 1.5 trillion, and 500 billion of it is those 4 stocks alone.
That sounds pretty close to accurate. So obviously there's some very big companies that are having an outside influence on equity market returns currently. But here's the email that I was forwarded just a few minutes earlier. A question for Eric. Suppose there is a nuclear war, a big earthquake, or tsunami, or some other big event that causes the market to drop several thousand points in a few hours or days. What are your immediate investment actions? And is there anything currently in place to mitigate this effects on client portfolios? And that is, I think, a very good question. I think the first answer I would have to that is the market is very efficient. So if you're anticipating making changes in response to an event, you're already too late if you do it after that event has occurred, because really markets react instantaneously. There is nothing we would do in terms of reacting to it unless we felt like that had changed the fundamental equation for the economy or for our client portfolios. If we felt that that required perhaps, or that was more of the onset of a fundamental shift, we might de-risk client portfolios in response to that. The second half of that question, I think, really refers to why an asset allocation is important for most investors. An asset allocation should target risk that client is comfortable with, and as long as your client portfolios or your portfolio is in a diversified portfolio, you should be able to mitigate some of that market reaction. But those events, and investors often refer to them as black swan events, those types of events do happen occasionally. We haven't had one for several years, but they are a part of the risk of investing, and understanding what your portfolio risk is something that's very important. So whether it's an asset allocation or even a equities only portfolio, what is the risk of that equity portfolio, and really, how do you anticipate that portfolio would do in the face of a significant market correction? And that's what I would advocate to this particular client is talk to us about the portfolio risk, and we'll help you find a level of risk that you're comfortable with.
Yeah, I was actually at dinner with clients last night, and the question came up about impeachment proceedings and the volatility that might come up with the portfolio at that time, or the markets at that time. And I think that really goes back to the slide, or the questions that we're getting goes back to your slide earlier regarding volatility. And I think when you have a lackluster market that doesn't have a lot of volatility, people start looking for it. They're wondering where it is because we are in an abnormal market at this point. Okay, so any additional questions? Let me just look through the chat here. Eric, I think you've probably addressed all the questions that we have today. Thank you for taking the time, and thank you to our clients for logging on. This is our second quarter economic update. We will have a third quarter review on September 12th. Eric and Xavier will be back for that one, and we'll have an opportunity to talk about what's going on in the third quarter a little bit before it ends, because at the end of the third quarter, Cutler's going to be very busy recognizing our first 40 years in business. That's September 27th, before Andy Frey out of our Bellevue, Washington office has an event on October 11th. That's going to be a webinar as well. So we look forward to having you at any of those events, or either of those events, rather, the investment call or the estate planning webinar. So thank you, everybody, for joining us today. We appreciate you coming in, and thank you for your business. And we look forward to talking with you soon. This will be posted to the website under our blog section. So if you want to send a friend, send a client, or review any of Eric's thoughts in the future, you're welcome to do so through the website. And if you have any questions that come to you after this presentation ends, please reach out. Eric and I are both available anytime to answer any questions you may have regarding the markets. So this concludes Cutler's second quarter investment call. Thank you, Eric, for your thoughts, and thank you all of you for joining us. Please have a great day.
Thank you very much.